Your income is more fragile than it appears. It feels stable, predictable, and under control, but that stability depends on a single condition remaining intact. Remove that condition, and the entire structure begins to weaken. The hidden cause is not how much you earn, it is how many ways you earn it. Most people believe income becomes safer as it increases. Higher salary, better job, more security. It feels rational. It feels responsible. It feels like progress. But the structure underneath doesn't change. One source still carries the entire system, and that creates a quiet contradiction. Because the more your life depends on one stream, the more exposed it becomes to disruption. Not dramatic disruption. Small ones. A delayed paycheck. A lost client. A shift in demand. A change you didn't anticipate. The visible effect is subtle at first. Income looks consistent. Expenses adjust around it. Lifestyle expands to match it. Everything appears aligned. But beneath that alignment, something else is forming. Dependence. The system begins to rely on continuous input from a single channel. As long as it flows, everything works. When it slows, pressure builds immediately. This is where most people misread the situation. They see income as a number, but the system responds to structure, and structure is where the difference begins. There are 4 types of income that quietly define whether a financial system remains fragile or becomes stable, not because they are superior individually, but because they distribute pressure across multiple sources. The first is earned income. This is the most visible, the most familiar, the most relied upon. It comes from time, effort, and direct contribution. A salary, a contract, a payment for work completed. It feels reliable because it is predictable, but it carries a hidden constraint. It only exists while you are producing it. The second is portfolio income. This is where money begins to operate independently of time. Capital-generating returns, dividends, interest, appreciation. It introduces separation between effort and outcome. But the effect is small at first, almost invisible, which is why it is often underestimated. The third is passive income, assets that continue producing after the initial effort has been applied. A product, a property, a system that repeats its output. It appears stable, but it depends on something less visible. Maintenance. The system continues, but it still requires oversight, adjustment, and reinforcement. The fourth is business income. This is where systems expand beyond individual capacity. Processes, teams, structures that generate revenue without direct involvement in every step. It creates leverage, but also complexity. Each of these income types introduces a different dynamic, not just in how money is earned, but in how risk is distributed. And this is where the mechanism becomes clearer. Most people operate almost entirely within the first category. Earned income dominates, which means their financial system is supported by a single active input. The moment that input weakens, everything else feels it. So they try to compensate. They work more hours. They increase output. They pursue stability within the same structure. But the structure itself doesn't change, which leads to the next layer, the behavioral trap. Because focusing on one income type feels efficient. It feels logical to optimize what is already working, to increase salary, to secure promotions, to strengthen the primary source. And it works. Until it doesn't. Because optimization within a single stream increases dependence on that stream. The system becomes more efficient, but also more concentrated, which makes it more sensitive. And over time, that sensitivity compounds. Expenses adjust upward. Expectations stabilize around consistent income. Flexibility decreases. This is where the structural lock-in begins. The system cannot easily shift because too much depends on one source. Introducing a second stream requires time, energy, and attention. But all of those are already allocated, so the system remains as it is. Stable on the surface, fragile underneath. This is the part that rarely gets recognized, because nothing appears wrong. Bills are paid, income arrives, life continues. but the structure has not diversified. And without diversification, stability is conditional. Now the recognition begins to move inward, because this isn't abstract, it's behavioral. Saving money, working longer hours, avoiding unnecessary risk, seeking predictable outcomes, following conventional financial advice. All of these actions align with building security, but they often reinforce the same structure, a single stream carrying increasing weight. And that alignment creates a quiet realization. You can be disciplined, consistent, and financially responsible, and still remain structurally exposed. Because the system has not expanded, it has only intensified, which leads to the next consequence. Time. Not in the sense of urgency, but in accumulation. Years pass within the same structure. Income grows, responsibilities grow, dependence grows, and the cost of change increases. Because shifting away from a single source becomes harder as more of life depends on it. This is where the point of no return begins to form. Not as a moment, but as a direction. The longer the system remains concentrated, the more difficult it becomes to redistribute. And the cost is not immediate loss. It is delayed flexibility, options that no longer exist, decisions that feel constrained, freedom that becomes conditional, all while the system continues to function. That is the paradox. It works until it needs to change. And when that moment arrives, the structure determines what is possible. Not intention, not effort, structure. The presence of multiple income types doesn't guarantee stability, but their absence guarantees dependence. Because each type absorbs pressure differently, earned income responds to effort, portfolio income responds to time, passive income responds to systems, business income responds to scale. Together, they distribute exposure. Separately, they concentrate it. And most systems never move beyond concentration. Not because people don't understand the idea, but because the shift is gradual, almost invisible. One small allocation, one additional stream, one system layered on top of another. It doesn't feel like transformation, it feels like adjustment, which is why it is often delayed, until the structure is already set. And by then, the system feels stable, even if it isn't. Because stability, in this context, is not the absence of disruption. It is the ability to absorb it. And absorption depends on structure, not income size, not intelligence, not effort, structure, which leads to a final observation. If one stream carries everything, then everything depends on one stream. If multiple streams exist, dependence begins to distribute. Not evenly, not immediately, but gradually, quietly, until the system no longer reacts the same way to disruption. And that change is not always visible. There is no clear moment where stability announces itself. No signal that the system has shifted. Only a gradual reduction in pressure, a subtle increase in flexibility, a quiet sense that something is different, even if it cannot be easily explained. Because the transformation is structural. And once structure changes, outcomes begin to follow, not instantly, not predictably, but inevitably. And that's where the realization extends beyond this moment. Because this isn't about one decision, or one stream, or one adjustment. It's about how systems evolve over time, and what they become when left unchanged. Because the question is no longer how much you earn, it is how your income is built. And once that question becomes clear, it doesn't go away. If you want more videos that explain how money actually works, you can subscribe to Finance Simplified.